Hi, good afternoon, everyone. So, this brings us to the second pending session of project appraisals. So, let's start with a quick recap of what we discussed. Accounting rate of return. ARR, accounting rate of return, is the average accounting profit from the project expressed as a percentage of the average investment. So, what you are actually doing is you are adding up the initial capital cost, if you see here, plus residual value divided by 2. So ARR is average net profit, average capital cost into 100. So this is also known as return on investment. Obviously, uh, you should select a project which is having highest accounting rate of return. All right, so let's understand the few nuances of ARR decision rule. Calculate the average investment of the project. Determine the profits after depreciation and taxes of the project. Determine the average annual profits of the company. Express the annual average profits as a percentage of the average invested capital. For a project to be acceptable, it must achieve at least a minimum targeted ARR. In normal case, it should be the highest, but if in case there is a tie, at least the minimum targeted ARR should be achieved. Where competing projects exceed the minimum rate, the one with the highest ARR should be selected. This is the crux. Because let's say, for an example, if you're investing in 100,000 rupees into a project, your main objective is the realization of money. How soon? And that is known as payback period. So select a project having lowest payback period. However, select the project, the return of the annual, the average rate of return should be higher. So select the project having highest ARR. This is a thumb rule. Advantage, I think we have discussed this. ARR advantages and disadvantages, very simple to understand and easy to calculate. Consider the profits of the project earned over the life of the project, allows projecting to compare, which require different amounts of initial capital investment. However, there are certain disadvantages which are no generally no general accepted definition, profits rather than cash flow. Ignore the timings of cash flows when you are getting it. No account of time value of money. The value of money is decreasing. The value of money is always decreasing. No indication of the capex, no indication of how much better organization would be undertaking the proposal. So these are certain advantages and disadvantages of ARR. So in normal life, so let me give you a quick recap. We discussed payback period. We discussed internal rate of return, IRR. We discussed ARR, average rate of return, which is more or less same. Then we discussed net present value, and then we also discussed the benefit cost ratio, BCR. Payback period should be lowest, IRR should be highest, ARR should be highest, net present value should be highest, benefit cost ratio should be highest. Also, if BCR equal to 0, it means your profits are equal to investments. Your return is equal to investments. If BCR is greater than 1, sorry, it should be equal to 1. If BC are greater than 1, then you are making more profits than investment. If BCR is less than 1, it means loss. You are loss. So these are certain thumb rules when selecting a project. Normally, in how should I say this? Like in a normal life, you will not get just one parameter to select from. It would be a mix of parameters. You will always have mix of parameters. So for that, you need to take a help from a CA or the finance guy. But at a prima facie, you should have the understanding of the basic financial health of the projects you are working in. For that, we are understanding. Plus, at times you will be in a situation where you need to justify the validity of your role, the validity of the project you are working in that case, it becomes extremely important that you have a fair understanding of how much value this project is bringing in on which you are working. How much value this project will bring in which you are part of. Value both in terms of tangible value both in terms of, just a second, let me fix that, or I should write here, no, tangible, which means, okay, let's leave that, tangible both and intangible. So this is the crux. All right, let's take an example of accounting rate of return. In year 1, you have net profit of 180,000. In year 2, you have a profit of 60. Year 3, again, you have a profit of 60. Initial capital cost is 1 million. Now calculate the ARR. Average capital cost is, you simply have divided the 1 million by 3, which comes down to 330,000 dirhams. Now average net profit is, you added up 180, 60, 60 and made a division by 3, which comes down to 100,000. Average net profit is this. Average capital cost is 330,000 and you just made a division, which comes down to 30%. ARR, if you anyways, or if you ever get a tie between two projects to choose from, you will always select the project which is having highest ARR. Okay, this is an example too. George put forward an investment proposal to his boss. The business uses ARR to assess investment proposals using a minimum hurdle rate of 27%. Details of the proposals were: cost of equipment 200,000, estimated residual value of equipment 40,000, average annual operating profit before depreciation is 48,000, estimated life of project is 10 years, annual straight line depreciation charge is 16,000, that is 200,000. This minus this divided by 10. The ARR of the project will be 48,000, which is average annual operating profit before depreciation minus annual straight line depreciation charges 16 divided by cost of equipment plus residual value of equipment divided by 2. So it's an average. So if you recall, average net profit upon average capital cost. So this is your net profit and this is your capital cost. This gives you 26.7%. Now, this second scenario is the boss rejected George's proposal because it failed to achieve an ARR of at least 27%. Although George was disappointed, he realized that there was still hope. In fact, all the business has to do was to give away the piece of equipment at the end of its useful life rather than sell it. The residual value of the equipment then becomes zero, and the annual depreciation charge becomes 200,000 minus 0 by 10, which comes down to 20,000 a year. The revised annual calculation was then 48. This will remain same, 48,000 minus 20,000. Earlier it was 16,000, so here it is 20,000 divided by 200,000 plus 0, because the residual value of the equipment then becomes 0, divided by 2, which comes down to 28%. So ARR here is higher than this one. Let's take another example, accounting rate of return. Reason is considering investing in one of the following indivisible projects. Required, using the table below, calculate the accounting rate of return. You have initial capital expenditure, expected annual profit of alpha project is 25,000, 15,000, 10, 3, 2, 5. Beta, you have 20,000, 10,000, 10,000, 5, 5, 4. Estimated resale value of equipment is, at the fourth year, 5,000 and 4,000. So let's do the calculation for the alpha project. Average annual profit is, so year 1, 15, 10, 3, 2 divided by 4, because 4 years, it comes down to 7,500. Average investment is 25, which is the initial capital cost. $25, which is the initial capital cost plus the residual value, which comes down to 30. 30,000 divided by 2 comes down to 15,000. Similarly, so average annual profit is 7,500 divided by 15,000 into 100 is 50%. Now here again you added up, divided by 4, 7,500. Average investment is here 20,000 plus residual value of 4,000 divided by 2 comes down to 12,000. You need a simple division of 7,500 divided by 12,000, 100,000, 62.50. Now if you see here, ARR is 50, here ARR is 62.50. This is beta, this is alpha, so you will definitely select the project beta over alpha because it has highest ARR. Alright, time value of money. Ask your friend if you can borrow 2,000 dirhams for 1 year. If he's rational, he would say yes, but he will want more back in the future. Why? What is the time value of money? Because the value of money is always decreasing. Therefore, you need to take care of the time value of money when using such calculations. The time value of money is social preference for money. People prefer to have money today rather than tomorrow. Inflation, economic term, example, rise in price, erosion in purchasing power. Risk, will you get your money back? Opportunity cost, what if someone else wants to borrow from you? These are the time value of money. Opportunity cost means you are losing an opportunity let's say you're losing an opportunity to serve someone else. This is known as opportunity cost. And perhaps you have lended your money to person A, and you have, the rate of interest, whatever you are getting is, let's say, it comes out to be 11. Person B, who could be your potential customer, was perhaps going to offer you 15. This is opportunity cost. So opportunity cost to serve A, the opportunity cost when you serve A is 15%. The thing that you miss because of A. Okay, time value of money. A bird in the hand is worth two in the bush. It's a proverb which says it is better to have less cash today than more credit day after tomorrow. Profits made in the short term more valuable than profits made in the long term. And then discounted cash flow techniques, net present value, and internal rate of return. Future value, how much is a pound today worth at some specific time in the future given a specific interest rate. As you know that the value of money is always decreasing, you need to calculate the value of your currency today with respect to some specific time in future. Okay, assume you invest dirham 100 in a bank for a year at 10% interest. After a year you will have 110. In other words, dirham 100 today is worth 110 in 1 year's time. So future value you calculate is you using the formula for future value is equal to present value. No, present value is equal to 1 plus r raised to power n. Or if you want to calculate present value, it should be future value upon 1 plus r raised to power n, where r is rate of interest, n is number of years. Okay, so compound factors, example 1, present value is 800. I is 8%, n is 4. So present value is equal to future value 1 plus r raised to power n. And you want to calculate the future value, you simply take it there. Present value is 800 into 1 plus rate of interest is 8 raised to power 4. Okay, so 1.08 raised to power 4 is 1.08 1.36. This is the result. Okay, compound interest, example 2. Bread is dirham 1 per loaf, therefore Dirham 100 buys 100 loaves. Assume inflation is 10%. Brad is now dirham 1.1 per loaf. Dirham 100 now buy 90 loaves, but 110 buys 100 loaves. So the purchasing power is decreasing the course of time. This is another example. Present value considers what the value of a future return represents in today's money given a specific estimated interest rate. The same formula, just they put the LHS towards right hand side, and hence it came into the division, where R is rate of interest and is number of years. What is the value in today's money of dirham 100, which is to be received in a year's time when the interest rate is 10%? What is the value in today's money? So you want present value. So simple formula is present value is equal to future value 1 plus r raised to power n. You put the numbers, and what you get is 90.91. In other words, if you had dirham 90.91 today and invested it at 10% interest rate for 1 year, you would have 100 at the end of that year. So this gives you the present value. Net present value, this is the most theoretically correct method. NPV is the present value of the future cash flow after netting out the initial cash flow. PV are achieved by discounting at the opportunity cost of capital. It involves a discounting of future cash flows, returns of investment. It determines their present value and compares it with the present value of the investment outlay. It is nothing but net present value is adding all the present values from instance 0 to instance n. That's it. So net present value, the formula for PV was future value upon 1 plus r raised to power n. So here PV is simply replaced by this formula, and you calculate it. Current future value 1 upon 1 plus r plus current future value 2 1 plus r raised to power 2 plus current future value 3 1 plus r raised to power 3, etc. Net present value, if the net present value is positive, it should be accepted. NPV is greater than 0. If it is less than 0, it should be rejected. And if it is equal to 0, which means you are no loss and no profit. In reality, the existence of risk and the limited availability of funding mean that most businesses seek a sustainability higher NPV, depending of course on the risk and the size of investment. NPV advantages are introduces time value of money. Yes, this considers time value of money, and hence it is discounted cash flow techniques. Enables the direct comparison of projects with different durations, can allow for inflation, allows what if scenarios. There are certain disadvantages, which are accuracy is limited by the production of future cash flow, biased towards short-term projects, excludes non-financial data, normally uses a fixed discount rate over the term of the project, and determination of appropriate discount rate can be problematic. Why is NPV better than ARR and payback period? Because the timing of the cash flows, the whole of the relevant cash flow, the objective of the businesses. Okay, I'll stop it here and then we will resume in our next discussion.